There is a ghost in your machine, an invisible script, a piece of code installed in your mind so early and so deeply that you mistake it for your own thinking. This script has a single, seductive command: seek the bargain, find the discount, hunt for what is cheap. This operating system governs how you buy a car, how you choose a restaurant, and most dangerously, how you attempt to build wealth. It whispers a comforting lie, that value is a function of a low price, that the greatest victories are won by paying less than an asset is currently worth on paper. This is the gospel of the bargain hunter, the creed of the quantitatively minded, the foundational logic taught in every business school and preached by every financial guru catering to the masses. It is also a psychological prison, a cognitive cage that locks you into a world of mediocrity. It is the single greatest barrier standing between you and the creation of generational wealth. Because the code that tells you to hunt for bargains is the very same code that blinds you to the existence of inevitability. Warren Buffett's $100 billion fortune is a monument, not to the mastery of this code, but to its complete and utter annihilation. His journey from a clever, statistically driven investor into a financial titan of mythical proportions was not a gradual incline. It was a violent, painful, and deliberate cognitive revolution. It was the forced uninstalling of the mental operating system he inherited from his own god, Benjamin Graham, and the installation of a new, radically different one. An operating system that shifted his focus from the obsolete language of price to the eternal grammar of quality. This is the story of that cognitive upgrade, the deconstruction of his most powerful mental model, the framework for identifying, valuing, and acquiring what he would come to call the wonderful company. This is not a stock-picking formula. It is a complete psychological architecture for rewiring your brain to see the world as he does, to see the invisible fortresses that protect certain businesses for centuries, to understand the profound difference between a fair business at a wonderful price and a wonderful business at a fair price. The first is an arbitrage, a clever trick that makes you a little money. The second is an invitation to own a piece of the future, a mechanism that can make you truly wealthy. Prepare to deconstruct the original sin of value investing, to witness the intellectual intervention that saved Buffett from a life of merely being rich, and to learn the 4 pillars of the cognitive framework he built in its place. This is the blueprint for the wonderful company mental model, the operating system for buying inevitability. To understand the revolution, you must first understand the orthodoxy. You must dissect the architecture of the mind that Buffett had to demolish before he could build his empire. That mind belonged to Benjamin Graham, the father of value investing, Buffett's professor, his mentor, his employer, and his intellectual North Star for the first 2 decades of his career. Graham was not just an investor. He was a product of trauma. His mind was forged in the fires of the Great Depression, a period that didn't just wipe out fortunes, but obliterated the very concept of a predictable future. For Graham, the future was a black box of unknowable horrors. Projections were fantasies, management promises were empty words, and the entire qualitative narrative of a business was suspect, likely a fiction designed to swindle you. In a world of profound uncertainty, the only thing you could trust was the cold, hard, verifiable present. The tangible assets on a balance sheet, cash in the bank, inventory in the warehouse, property, plants, and equipment. Graham's response to this trauma was the creation of a psychological fortress. His entire system, which he called intelligent investing, was a defense mechanism against a hostile and unpredictable world. At its core was the principle of the margin of safety, a concept we have deconstructed before, but its most extreme application was a strategy he called net-net investing, or as Buffett would later call it, the cigar butt approach. The logic was brutally simple and deeply cynical. A cigar butt found on the street is a disgusting thing. It is soggy, used, and unwanted. But if it has one free puff left in it, and you can acquire it for nothing, you have made a profit. You take that one free puff, and you discard it. You do not fall in love with the cigar butt. You do not hope for a second puff. You do not imagine a future with the cigar butt. You simply extract its last tiny remaining sliver of value and move on. Graham translated this into a mathematical formula. He would search for companies trading for less than their net current asset value. This means you would calculate the value of a company's current assets, cash, receivables, inventory, and subtract all of its liabilities, both short-term and long-term. If the company's stock market valuation was less than this number, you were essentially getting the business for free. You were buying the cash in the bank and the inventory in the warehouse for, say, 70 cents, and as a bonus you got the factories, the brand, and the entire operating business for less than zero. This was the ultimate bargain. It was a strategy completely insulated from the future. It didn't matter if the business was terrible. It didn't matter if the management was incompetent. It didn't matter if its industry was dying. The mathematics were so compelling, the discount to tangible, liquidatable assets so profound, that a small profit was almost statistically guaranteed. You would buy a portfolio of dozens of these pathetic, ugly, unloved cigar butt companies. Many would fail, some would tread water, but a few would liquidate or be acquired, and the value of their assets would be realized, providing a profit for the entire portfolio. This was Buffett's first operating system. He learned it, he mastered it, he practiced it with a monk-like devotion, and it worked. He became a millionaire in his 20s, running his investment partnership with this exact methodology. He was a brilliant cigar butt investor. But this system, this psychological fortress built by Graham, was also a cage. The cognitive architecture of a cigar butt investor has profound and crippling limitations. First, it is inherently cynical. It trains the mind to see businesses not as living, breathing organisms with potential, but as a static collection of assets to be liquidated. It is a scavenger's mindset, not a builder's. It actively screens out quality, because quality is never available at such a pathetic price. A truly great business, a company with a brilliant future, is never trading for less than the cash in its bank account. So the very first step of the cigar butt system is to eliminate all wonderful companies from consideration. Second, the strategy is not scalable. As Buffett's capital grew from thousands to millions, it became impossible to deploy significant sums of money into these tiny, obscure, garbage companies. You can't invest $100 million in companies with a market capitalization of $2 million. The strategy that made him a millionaire was incapable of making him a billionaire. It had a ceiling, a hard-coded limit to its potential. Finally, and most importantly, the system is fundamentally flawed because it ignores the most powerful force in the universe of finance, the power of compounding. A cigar butt provides one puff. It gives you a quick, small, discrete profit. Then you have to find another one, and another, and another. It is a life of constant activity, of buying and selling, of searching for the next piece of trash. A wonderful business, on the other hand, is the gift that keeps on giving. It is a machine that generates more and more cash over time, compounding its intrinsic value year after year, decade after decade. Owning a wonderful business allows you to harness the power of time, while being a cigar butt investor forces you to fight against it, constantly needing to find a new idea as the old one plays out. The ultimate symbol of this flawed operating system was Buffett's purchase of the textile mill, Berkshire Hathaway. He bought it in 1964. On paper, it was a classic Graham investment. It was cheap. The stock was trading for far less than the company's working capital. Buffett saw the value of the looms, the thread, the factories. He saw the cigar butt. What he failed to see was the economic reality. It was a terrible business in a dying industry. It was a capital-intensive nightmare. Every year it had to spend millions of dollars on new equipment just to remain competitive with foreign producers. And even then, it could barely eke out a profit. The business was a black hole for capital. It was a boat that was constantly leaking. And Buffett was constantly bailing, pouring good money after bad just to keep it afloat. For 20 years, this textile mill was a psychological and financial anchor around his neck. It was the ghost in his machine, the physical manifestation of the limitations of Graham's philosophy. It was a fair company at a wonderful price, and it became one of the biggest investment mistakes of his life. Not because it lost him money directly, but because the capital he poured into that sinking ship for 2 decades could have been invested in the truly wonderful businesses he was just beginning to understand. It was the opportunity cost that was catastrophic. The prison of the cheap mindset had trapped him. He knew the system was breaking. He knew he was hitting the limits of Graham's world, but he didn't know how to escape. To do that, he would need an intellectual crowbar, a force so powerful it could pry his mind from the foundations laid by the man he revered most. That force was Charlie Munger. If Benjamin Graham was the architect of Buffett's first mental operating system, Charlie Munger was the cognitive neurosurgeon who performed the radical, life-altering procedure to replace it. To call Munger a partner is to fundamentally misunderstand his role in the Buffett story. He was a catalyst, a provocateur, an intellectual agitator whose thinking was operating on a completely different plane from the cynical, quantitative world of cigar butt investing. Munger was not a Graham disciple. He was a polymath, drawing insights from psychology, physics, biology, and history. He didn't see a business as a balance sheet. He saw it as a complex adaptive system, an ecosystem with its own set of rules and evolutionary pressures. Where Graham's primary question was, what is it worth right now? Munger's was, what is this business going to look like in 10, 20, 50 years? He was obsessed with the qualitative, the durable, the aspects of a business that were not easily captured by an accounting statement, but were responsible for almost all of its long-term value. The collision of these two minds, Buffett's deep, Graham-like discipline, and Munger's expansive, multidisciplinary latticework of mental models, created the intellectual fusion that would become the modern Berkshire Hathaway. Munger's intervention was not a single conversation, but a years-long campaign to deprogram Buffett from his cigar butt addiction. He relentlessly hammered on one central theme, an idea that was utterly heretical to the Graham doctrine. This idea, this Munger axiom, can be summarized in a single, powerful sentence that represents the most important cognitive shift in modern financial history. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Let us deconstruct this sentence, for within it lies the source code of Buffett's new operating system. A fair company at a wonderful price. This is the cigar butt. This is the dying textile mill. This is the world of Graham. The appeal is the price. The wonderful price is the hook. It provides a quick, mathematically certain profit. But the business itself, the fair company, is an anchor. It doesn't grow. It consumes capital. Its long-term trajectory is flat or downward. The game is to get out before it sinks. Now, consider the alternative, a wonderful company at a fair price. The entire emphasis has shifted. The primary object of analysis is no longer the price, but the company. The word wonderful is doing all the work. It implies a business with intrinsic qualities so powerful that they create their own tailwinds. A business that grows, that compounds its value, that generates mountains of cash over time. The price you pay is secondary. It needs to be fair, meaning you can't wildly overpay, but you are no longer hunting for the 50-cent dollar. You are not looking for statistical cheapness. You are looking for structural greatness. You are willing to pay a reasonable price, a price that might even look expensive to a Graham disciple, because you are not buying the assets of today. You are buying the earnings power of the next several decades. This is not a tweak to the old system. It is a complete inversion of it. It requires an entirely different set of mental tools and a profoundly different temperament. To be a cigar butt investor, you need to be a good accountant and a cynic. To be a wonderful company investor, you need to be a good business analyst, a historian, and a psychologist. You have to evaluate management, understand the competitive landscape, and have the foresight to judge a company's durability over time. You are shifting from a quantitative game to a qualitative one. The psychological leap required for Buffett to cross this chasm was immense. It meant abandoning the mathematical certainty that had made him rich and safe. It meant embracing a degree of subjective judgment about the future that Graham had explicitly warned against. It was an act of intellectual heresy. And like all great leaps of faith, it required a proving ground. A single, real-world test case that would either validate Munger's radical philosophy or prove it to be a dangerous fantasy. That test case arrived in 1972. It was a small, family-owned chocolate company based in California. It was called See's Candies. See's was, by every Graham metric, a terrible investment. The company was being offered to Berkshire Hathaway for $25 million. Its book value, the tangible value of its assets, was only about $8 million. This meant Buffett would be paying a price 3 times higher than the value of all the stores, kitchens, and inventory combined. The old Buffett, the Graham disciple, would have laughed and walked away. The very thought of paying such a premium for goodwill, for an intangible brand name, was anathema to his programming. He almost did walk away. He initially balked at the price. It was Munger who pounded the table. Munger saw what the balance sheet could not. He saw the, quote, wonderful company. He saw the fanaticism of its customers. He saw the deep emotional connection people had to the brand, forged over generations of birthdays, holidays, and gifts. He saw that this brand loyalty gave See's incredible pricing power. Every year, they could raise the price of their chocolates, and customers wouldn't just accept it. They would happily pay it, because See's wasn't just candy, it was a tradition. This pricing power, this intangible asset, was a goldmine. It meant the company could generate increasing profits without having to invest any significant new capital. It was a cash-gushing machine. Munger's argument was that the balance sheet was a historical document, a snapshot of the past. The brand, the customer loyalty, the pricing power, that was a map of the future. He convinced Buffett to make the leap, to override his deepest quantitative instincts and pay the $25 million. That decision was the single most important turning point in Warren Buffett's career. See's Candies became the prototype, the Rosetta Stone for the wonderful company model. Since 1972, that little $25 million investment has generated over $2 billion in pre-tax earnings for Berkshire Hathaway. All of that cash was sent back to Omaha, where Buffett could then reinvest it into other wonderful companies. See's Candies taught Buffett the economics of quality. It proved in undeniable financial terms that the intangible fortress of a great brand was worth far more than the tangible bricks and mortar of a mediocre factory. It was the one free puff of a cigar butt versus a fountain of cash that would never run dry. The experience didn't just make him money, it rewired his brain. It completed the deprogramming process Munger had started. The ghost of Benjamin Graham was exorcised, and the new operating system, the wonderful company code, was fully installed. From that point forward, the central quest of Warren Buffett's life would not be to find things that were cheap, but to find things that were wonderful. The rest of his career would be dedicated to building and refining a cognitive framework to do just that, a framework built on 4 essential pillars. With the See's Candies experience as his new foundational data point, Buffett, guided by Munger's expansive intellect, began to architect a new, formal, mental operating system. The goal was no longer to find statistical bargains, but to systematically identify businesses with enduring, near-invincible characteristics. He needed a repeatable process, a cognitive checklist to filter the entire universe of businesses down to the tiny handful that met the definition of wonderful. This process crystallized into a 4-pillared framework, a mental edifice that supports every major Berkshire Hathaway acquisition of the last 50 years. These pillars are not a simple financial checklist. They are 4 distinct cognitive lenses, each designed to analyze a different dimension of a business's quality. Mastering this framework is to train your mind to see the invisible architecture of corporate greatness. The first and most famous of these pillars is the search for an invincible business, a concept he would famously label the economic moat. A moat is a metaphor for a sustainable competitive advantage. It is a protective barrier, a deep, treacherous trench around a company's economic castle that keeps competitors at bay and allows the company to earn high returns on its capital for decades. In a previous deconstruction, we analyzed the concept of the moat itself. Here, we must understand it as the first and most critical filter in the wonderful company operating system. Buffett's genius was in categorizing and identifying the specific types of moats that were most durable. He understood that not all advantages are created equal. Some are fleeting, while others can last for a century. His framework focuses on four primary sources of a deep and sustainable moat. The first is intangible assets. This is the magic Munger saw in See's candies. It includes brands, patents, and regulatory licenses. A powerful brand is a psychological moat built in the minds of millions of consumers. Think of Coca-Cola. For over a century, the name itself has evoked feelings of refreshment, happiness, and nostalgia. This mental real estate is almost impossible for a competitor to seize. A new soda company could have a better taste, a cheaper price, and a bigger advertising budget, but it cannot replicate the 100 years of accumulated memories and positive associations that Coke owns. This allows Coca-Cola to command a premium price and maintain a massive global market share. The brand, though only an idea, is a more formidable barrier than any factory or distribution network. Similarly, patents grant a legal monopoly for a period of time, and regulatory licenses, like the ones required to operate a railroad or a credit rating agency like Moody's, create a state-sanctioned fortress that legally bars new entrants. The second type of moat is high switching costs. This is a psychological and financial moat based on the pain and expense a customer would have to endure to switch from your product to a competitor's. Think about the operating system on your computer. Whether it's Windows or Mac OS, the thought of switching is a nightmare. You'd have to learn a new interface, repurchase all your software, and transfer all your files. The switching cost is so high that the competitor would have to offer a product that is not just slightly better, but monumentally better, to convince you to make the leap. This creates a powerful inertia that locks in customers and guarantees recurring revenue. This moat is common in enterprise software, banking, and data management systems. It's a moat built on customer complacency and the high friction of change. The third type of moat is the network effect. This is a particularly powerful advantage where a product or service becomes more valuable as more people use it. The classic example is the credit card. American Express is valuable to a cardholder because it is accepted by millions of merchants. It is valuable to merchants because it is carried by millions of affluent cardholders. Each new user on one side of the platform increases the value for users on the other side. This creates a virtuous cycle, a feedback loop that builds an impenetrable fortress. A new competitor faces a massive chicken and egg problem. They can't get merchants without cardholders, and they can't get cardholders without merchants. The network effect creates a winner-take-all, or winner-take-most dynamic, resulting in a dominant high-return business like Visa, MasterCard, or American Express. The final and most intuitive moat is a durable cost advantage. This is the ability of a company to produce and deliver its goods or services more cheaply than its competitors. This advantage can come from two places: process or scale. A process advantage comes from a unique, proprietary method of doing business, like Geico's direct-to-consumer insurance model, which bypasses the costly agent network used by traditional insurers. A scale advantage comes from being so large that your per-unit costs are lower than anyone else's. Walmart and Costco are the titans of scale. Their immense purchasing volume allows them to negotiate lower prices from suppliers than any smaller retailer could. A discount they then pass on to customers, which attracts more customers, which increases their scale even further. It is another powerful, self-reinforcing feedback loop. This first pillar, the economic moat, is the non-negotiable starting point. If a business does not have a clear, durable, and identifiable competitive advantage from one of these four sources, it cannot be a wonderful company. It is, by definition, a commodity business subject to the brutal forces of price competition. And for the post-Munger Buffett, investing in commodity businesses, no matter how cheap, was a fool's errand. A business without a moat is a castle without walls, destined to be overrun. Once a company has passed the first filter, once it has been identified as an economic castle with a deep and treacherous moat, the second pillar of Buffett's framework comes into play. This pillar moves from analyzing the structure of the business to analyzing the character of the people running it. This is the pillar of the aligned steward, the management doctrine. This is perhaps the most overlooked and psychologically nuanced part of his entire operating system. The post-Munger Buffett understood a profound truth. Even the most magnificent castle will crumble if its steward is a fool or a knave. He is not just buying a collection of assets and competitive advantages. He is entering into a long-term partnership with the company's management team. He is entrusting them with his capital, and by extension the capital of his shareholders. Therefore, evaluating the quality of that management is not a soft, secondary consideration. It is a hard, primary filter, as crucial as the moat itself. To do this, Buffett developed a psychological profile, a cognitive checklist for identifying the ideal corporate steward. He looks for three essential traits: rationality, candor, and independent thinking. The first and most important trait is rationality. For Buffett, rationality in a CEO has a very specific definition. It is the ability to allocate capital intelligently. A business, at its core, is a machine that takes in capital and, one hopes, spits out more capital. The CEO is the operator of that machine. The primary job of the CEO is to decide what to do with the cash the business generates. There are 5 possible options: reinvest it back into the business, acquire other businesses, pay down debt, pay it out to shareholders as a dividend, or buy back the company's own stock. A rational CEO will dispassionately evaluate these 5 options and choose the one that creates the most long-term value for shareholders. This sounds simple, but in the real world of corporate America, it is exceedingly rare. Most CEOs are driven by ego, by a desire to build empires, not by a cold, hard calculation of return on investment. They will pursue growth for growth's sake, making foolish acquisitions at inflated prices just to make their company bigger. They will pour money into projects with low returns just to expand their fiefdom. Buffett calls this the institutional imperative, the tendency for corporate leaders to mindlessly imitate their peers, to expand their empire regardless of the consequences for shareholder value. A rational CEO, in contrast, resists this. If there are no high-return opportunities to reinvest in the business, they will have the discipline to return the capital to shareholders. They treat the shareholders' money as if it were their own. They think like owners, not like employees. Buffett's primary tool for judging this is to read a company's history, particularly its annual reports. He studies their past capital allocation decisions. Did they make smart acquisitions? Did they buy back stock when it was cheap? Did they avoid diversification, expanding into businesses they didn't understand? The historical record of a CEO's capital allocation decisions is the single best predictor of their future rationality. The second essential trait is candor. This is about honesty, not just with the public, but with themselves. A great manager must be willing to report on their failures with the same clarity as their successes. This is another trait that is almost pathologically rare in the corporate world. Most CEO communications, particularly annual reports, are exercises in public relations and obfuscation. They are filled with jargon, euphemisms, and carefully crafted narratives designed to highlight the good and hide the bad. Buffett reads these documents with the eye of a detective, searching for the telltale signs of a candid mind. Does the CEO speak in plain English? Do they admit their mistakes and take responsibility for them? When they had a bad year, do they blame it on external factors, or do they analyze their own operational shortcomings? Buffett's own annual letters to Berkshire Hathaway shareholders are the gold standard for this. They are masterpieces of clarity, wit, and, most importantly, brutal honesty. He famously details his mistakes, his unforced errors, often in excruciating detail. This is not just an act of humility, it is a signal. It tells shareholders that he is living in reality, that he is not deluding himself, and that he can be trusted to be a faithful steward of their capital. A manager who cannot speak honestly about their failures is a manager who cannot learn from them. The final trait is independent thinking, which is directly related to resisting the institutional imperative. Does the management team have the courage to be different? Are they willing to look foolish in the short term to be right in the long term? The corporate world is a massive herd. CEOs go to the same schools, read the same publications, and hire the same consultants. This leads to a tremendous pressure to conform. If every other company in the industry is making a certain type of acquisition, it takes immense psychological fortitude to be the one company that says no. Buffett looks for managers who have demonstrated a history of zigging when the rest of the world zags. He looks for mavericks, for people who are driven by an internal logic, not by the applause of Wall Street or the headlines in the financial press. This is, of course, a reflection of his own psychological makeup. His entire career is a testament to the power of independent thought. He seeks out managers who are cut from the same cloth. This three-pronged psychological profile, a rational capital allocator, a candid communicator, and an independent thinker, is Buffett's filter for identifying the kind of management he can trust for decades. Without this pillar in place, even the widest moat is vulnerable. A brilliant business can be run into the ground by a foolish or dishonest manager. For Buffett, the business and the manager are inseparable. A wonderful company requires a wonderful steward at the helm. With the first two pillars, a structurally invincible business and an aligned high-character management team firmly established, the third pillar of the framework addresses the crucial element of predictability. It's not enough for a business to be great today. A truly wonderful company must be one whose future is, to a reasonable degree, knowable. This is the pillar of the predictable future, a concept that is a direct application of another one of Buffett's core mental models, the circle of competence. We have deconstructed the circle of competence before as a tool for intellectual honesty, for knowing the boundaries of your own knowledge. Here, in the wonderful company framework, it serves a more specific, offensive purpose. It is a litmus test used to filter out businesses whose long-term competitive dynamics are too complex or fast-changing to reliably forecast. Buffett is not trying to predict the future. That is a fool's game. Instead, he is trying to identify businesses whose futures are so stable and probable that they require very little prediction at all. His central question is this: can I, with a high degree of confidence, understand what this business will look like in 10 or 20 years? If the answer is no, he moves on, no matter how attractive the business may seem today. This explains what is often mischaracterized as Buffett's anti-tech bias. For decades, he famously avoided investing in technology companies like Microsoft or Intel, even as they were generating immense wealth. This was not because he disliked technology or failed to recognize its importance. It was a direct and humble application of this third pillar. He would ask himself, in 1995, could anyone have confidently predicted which search engine would dominate in 2015? Could anyone in 2005 have known what the smartphone landscape would look like in 2025? Which social media platforms would rise and fall? The pace of change in the technology sector is ferocious. The moats, while they can be powerful, are also constantly under assault from disruptive innovation. A dominant company can be rendered obsolete in a matter of years. The creative destruction, as the economist Joseph Schumpeter called it, is simply too intense. For Buffett, the range of potential outcomes for most technology companies is too wide to make a confident, long-term bet. Contrast this with the businesses he does own. Consider Coca-Cola in 1988, when he made his famous investment. Could he predict with a high degree of confidence what the world would look like in 2008? No. But could he predict that people would still be drinking Coke? Yes. Could he predict that the brand would remain dominant? Yes. Could he predict that the company's global distribution system would still be a massive competitive advantage? Absolutely. The fundamental economics of the business were highly stable and predictable. The same is true for See's Candies. People will continue to give chocolate on Valentine's Day. The same is true for Geico. People will continue to need car insurance, and they will continue to prefer a low-cost provider. This pillar is not about avoiding change. It is about seeking businesses that are insulated from the most destructive forms of change. The test for this is what Munger calls the test of time. Buffett and Munger will study the history of a business and an industry going back decades, sometimes even a century. Has the business survived and thrived through multiple economic cycles, recessions, booms, and periods of high inflation? Has it navigated significant technological shifts without losing its core competitive advantage? Have consumer tastes changed? And if so, how did the business adapt? A long history of durable success is the single best indicator of a predictable future. It demonstrates a level of resilience and adaptability that a younger company has not yet proven. This is why Buffett is often drawn to simple, boring, time-tested businesses. He is not looking for excitement, he is looking for certainty. The psychological discipline required to adhere to this pillar is immense. It means saying no to 99% of the opportunities that come along, including many that go on to be spectacularly successful. It means watching from the sidelines as others get rich on the hot new trend. It requires a profound humility, an admission that the future is largely unknowable, and a ruthless focus on the small number of things that are. For Buffett, an investment is not a speculation on a brilliant but uncertain future. It is the purchase of a predictable stream of future cash flows. If that stream is not visible and reliable for a very long time, the company, no matter its current performance, cannot be considered truly wonderful. It fails the test of predictability and is discarded. This filter ensures that he is only playing in games where he knows he has an edge, where the odds are overwhelmingly stacked in his favor, not by predicting the future, but by confining his investments to the tiny sliver of the business world that is largely immune to it. After a business has passed through the first three gates, possessing a durable moat, run by aligned stewards and operating in a predictable industry, it must face the final quantitative pillar. This is where the abstract qualities of the business are translated into the cold, hard language of numbers. This is the pillar of the financial engine, a lens focused on understanding the true economic horsepower of a company. For Buffett, traditional accounting metrics are often insufficient and misleading. He needed a more precise tool, a cognitive lens for seeing a company's real, underlying profitability, stripped of the fictions and conventions of generally accepted accounting principles, or GAAP. This led him to develop his own concept, the holy grail of his financial analysis: owner earnings. In his 1986 letter to shareholders, Buffett laid out the definition. Owner earnings is the company's reported net income, plus non-cash charges like depreciation and amortization, minus the average annual amount of capital expenditures the business requires to maintain its long-term competitive position and unit volume. This sounds technical, but the mindset behind it is revolutionary. Buffett is asking a simple, powerful question. If I owned this entire business myself, how much cash could I take out of it at the end of the year without damaging its future prospects? That is the true profit. Reported net income is an accountant's opinion. Owner earnings is an owner's reality. The most crucial and subjective part of this calculation is estimating the maintenance capital expenditures. This is the amount of money the business has to spend each year on things like upgrading factories and equipment, just to stand still, just to keep its moat from silting in. A business in a highly competitive, capital-intensive industry, like the Berkshire Hathaway textile mills, might have to spend all of its depreciation charges and more just to keep up. Such a business might have high reported earnings but very low, or even negative, owner earnings. It is a capital-guzzling machine. A truly wonderful business, on the other hand, requires very little capital to maintain its position. Think again of See's Candies or Coca-Cola. Their moats are their brands, which exist in the minds of consumers. They don't need to spend billions on new factories every year. They have low-maintenance capital needs. As a result, their owner earnings are immense. They are capital-light compounders. They gush cash. This leads directly to the ultimate financial metric in Buffett's operating system: a high and sustainable return on tangible capital. A business that can consistently generate high profits relative to the net tangible assets required to run the business is the financial engine of a wonderful company. A company that earns, say, 25% on its tangible capital can reinvest its profits and grow its intrinsic value at a very high rate without needing to take on debt or issue new stock. It becomes a self-funding, compounding machine. This is the ultimate sign of a great business. It is the financial proof of the existence of a moat. A business that earns commodity-like returns of 6 to 8% on its capital has no moat. The forces of competition are eroding its profitability. A business that can consistently earn 20%, 30%, or even more on its tangible assets has some powerful competitive advantage protecting it, allowing it to defy the economic laws of gravity. Buffett's ideal business is one that can employ large amounts of capital at very high rates of return. This financial pillar is the final check. It ensures that the qualitative story, the moat, the management, the predictability, is validated by the quantitative reality. A company might seem to have a great brand and great managers, but if it cannot translate those advantages into superior financial returns, then something is wrong in the analysis. The four pillars must stand together. A business must have a durable moat, be run by honest and rational managers, operate in a predictable industry, and, as a result of these things, produce high returns on tangible capital with strong owner earnings. When a company passes all four of these filters, it earns the title of wonderful. At that point, and only at that point, does the final piece of the Munger axiom come into play: the fair price. Finding a wonderful company is the hard part. The final step is to wait with the patience of a saint for the opportunity to buy it at a sensible valuation. A fair price is not a cigar butt price. It is a price that provides a reasonable rate of return on the investment, assuming the business continues to perform as expected. This final step requires a temperament of extreme patience and the emotional fortitude to act decisively when the opportunity presents itself, often when the market is gripped by fear and pessimism. This complete four-pillared framework is the intellectual machinery behind the modern Berkshire Hathaway. It is the operating system that transformed Buffett from a clever cigar-butt scavenger into the world's greatest compounder of capital. It is a testament to the power of a deliberate and painful cognitive upgrade, a shift from the seductive logic of cheapness to the enduring wisdom of quality. What we have deconstructed here is more than an investment strategy. It is a complete mental operating system for making high-consequence decisions under uncertainty. It is a blueprint for rewiring your own mind to prioritize the long-term over the short-term, quality over quantity, and intrinsic reality over external perception. Let us synthesize the core architecture. It began with a foundational demolition, the recognition that the inherited wisdom of Benjamin Graham, the seductive logic of the bargain, was a psychological cage. It was a system built for survival in a world of scarcity, but it was incapable of generating exponential wealth in a world of opportunity. The catalyst for the demolition was the intellectual intervention of Charlie Munger, who introduced the radical axiom that a wonderful business at a fair price is infinitely superior to a fair business at a wonderful price. This was not a minor adjustment. It was a 180-degree inversion of priority, shifting the focus from the price tag to the intrinsic quality of the asset itself. This new philosophy was proven and battle-hardened with the acquisition of See's Candies, an investment that was quantitatively expensive but qualitatively priceless. From this successful rewiring, a new, four-pillared cognitive framework was built. Pillar 1. The invincible business, the search for a durable economic moat, an intangible asset, a switching cost, a network effect, or a cost advantage that protects the business from the ravages of competition. Pillar 2. The aligned steward, a psychological profile of management that filters for rationality in capital allocation, candor in communication, and the courage of independent thought. Pillar 3. the predictable future, an application of the circle of competence that ruthlessly filters out businesses whose long-term futures are unknowable, focusing only on those with a demonstrated history of resilience and stability. And finally, Pillar 4, the financial engine, a quantitative verification that uses the concepts of owner earnings and high return on tangible capital to ensure the qualitative strengths of the business translate into real, cash-generating power. This four-part system is a machine for identifying inevitability, but installing this operating system in your own mind requires more than just intellectual understanding. It requires a profound emotional discipline. It demands the patience to do nothing for years at a time, waiting for the perfect convergence of a wonderful company and a fair price. It demands the courage to act decisively, often in multi-million or multi-billion-dollar size, when that moment arrives. It demands the humility to stay within your circle of competence, watching others get rich on ventures you do not understand, and feeling no envy. It requires, in essence, a mind that is completely insulated from the noise, the greed, and the fear of the surrounding world. And this reveals the final, most crucial layer of the entire system. This ability to calmly and rationally evaluate a business based on its internal merits, completely ignoring the manic-depressive screams of the stock market, is not a standalone skill. It is the direct output of a much deeper, more foundational mental model that governs every aspect of Warren Buffett's life. To judge a company by its internal scorecard, its moat, its management, its economics, you must first learn to judge yourself by an inner scorecard. You must possess a sense of self-worth that is entirely derived from your own standards, your own intellectual work, your own character, not from the applause or criticism of the crowd. You must uninstall the outer scorecard that makes you crave the market's approval and install the inner scorecard that grants you cognitive sovereignty. The framework for seeing a wonderful business is merely an extension of the framework for building a sovereign mind. The tool is a reflection of the man. To truly wield the wonderful company model, you must first build the psychological platform upon which it rests. To deconstruct that master algorithm, the very core of Buffett's psychological operating system, the source code of the inner scorecard, click the video appearing on your screen right now.